Good morning, everyone. Happy Monday. How's everybody doing? Hey, Raj. Hey, Rasta. What's going on? Hey, Tim. So, before I start the video, you'll notice that I am using the old contract. I've done the rollover calculations and everything. Well, not calculations, adjustments. I'll have the new one out for the next session for 9 a.m. The only reason I'm using this one, because when I started looking at it, um, the volume still a little bit higher. 25,000 in the old one, 19,000 in the new one. The new one should catch up and overtake the old one today. So I've got all the references. You can see it's about 60 points higher, right? So um, we've got all that done. I'll bring that out and I'll post levels on Twitter. So here we are, folks. We're splitting volume equally almost between two different contracts. Slow order flow. Our overnight inventory is long, and I told you guys in the weekend update video that we posted that this inventory, the sell-off, they're going to take that and they're going to sell it up here, and that's exactly what we're doing, right? What something that you can look out for is if you understand how markets work, right? And this it's not a complicated thing, right? If you look and understand how a market works, you'll see Friday we had liquidation at the end of the day, right? Hey Phil, what's going on? So when you have a liquidation, you what happens? You get liquidating inventory, right? So you get retail and wholesale, you get retail and everyone's trapped up here and they start puking, right? Because it's not breaking out over 6606 on Friday. So everybody starts throwing up contracts at the end of the day. Nobody wants to hold it over the weekend at 6604. So they start puking it out and dumping, right? Hey Dan, they sell it off. It's taken into wholesale hands here. Okay? And what do you do? What does a car dealer do when they sell a car back to you? Right? You sell the car here, you buy it back from the retail customer here, and then what do? You clean it up, put some armor all on the tires, and then you go put it back out on the lot, right? Market, market, right? That's what you do when it's a market. You're trying to move inventory, right? So that's exactly what's going on. A lot of times you'll see this. A market will liquidate and everyone will get short because they think this is going to happen. Now look at that. Friday we did not fill those single prints. We did in the Globex session at night. But Globex is like Vegas. What happens in Vegas stays in Vegas. What happens in Globex stays in Globex. What happened was when Globex came down here and filled these single prints Thursday night, they just got all the cheap inventory and there's nothing for sale underneath Friday's low. And look at tonight's low. This is a poor low. Right here. Right? So there are trap shorts right underneath the overnight low. Right? So we're going to take that cheap stuff that we got from these people who puked it out, right? The wholesalers are the ones with all the money. They can hold and take in positions, right? Hold it over the weekend and then start getting rid of it at night, right? That's just how business works. If you understand that, then you're not going to be. A lot of people have these crazy ideas, right? This indicator is telling them to short it here. They get short in the hole. You can tell people are short in the hole because we have a poor low in the overnight low. Let's go take a look at it. So now we're going to distribute up here, see if we can get people to buy it. No, we filled the single prints. There's that poor low I was talking about right here. See? One tick of excess right where the end stop is to the tick. So the shorts are still trapped here and here and here. So on any kind of retracement, these are where you're going to be looking for bids. Okay? And if those levels break, you'll look for the next set of single prints. Lower stops, right? And our big area of interest is down here, 65.19 to 65.25. This area here, if we get back down here, who knows this week? I don't know what the Fed's going to do this week. You know, if they don't lower interest rates, I'm sure we'll get some selling. Right, our overnight POC is at 65.91, looking to go move those 733 contracts. We're going to try and sell them up here and move that point of control up to show good distribution. My balance zones are here. So my balance zone was 86.75 to 88.75. I did my balance zones here. My eye was just drawn to this area right here. Right in this area here. Highs, lows, back and forth. Double it to 65.92. Double it again to 66.75. So, yeah, that's basically it. Now, how in God's name are you going to trade this market? Well, scalping is going to be a little harder today because you're going to have less follow through. Why? Right? Because you're splitting volume between two contracts, right? So there might be less follow through. So the way you have to trade this is you have to build positions. So if you were trading this, and I did a video on this on the weekend, it's in the room, right? So if you were thinking long, right, and you want to build a long position, you're going to be building a long position in this area once it's reclaimed this level, right? And then sell into this strength. Build position, sell into strength. I don't see a short position to be built right now, right? Hey, Alexander, what's going on? But if you're trading, you're going to have to be a bit more patient, right? Less volume means easier to move both ways. But the problem is, trade maker, we call those stray orders. So you don't know when they're going to come in. Like, so it's easier to move if you're a larger trader, but we don't know when those orders are going to drop. So it's very unpredictable. You know what I mean? That's the problem. The problem is, yeah, there's less volume, easier to move and manipulate it, but we don't know when those large orders are going to drop, so we can't really bake that into our execution scenario, right? So, what have you guys learned in the last, since we've been doing this? All-time highs are unpredictable. All-time highs with a contract rollover when you're splitting the volume between two contracts are even worse. And all-time highs with a contract rollover right before a Fed event, you've got the perfect trifecta for crappy price action, right? Like if you were like, doing a recipe for bad price action, this would be the perfect recipe. It's like Michelin 3-star bad price action recipe. Right? You've got everything. The only way you can trade this is to take trades and hold them a little longer. Yeah. I don't like trading in the middle, right? And complete transparency, Friday, Thursday, Wednesday, and I think Tuesday, for those 4 days, I did not trade Globex at all. I did maybe a scalp or two with you guys when I was on YouTube, and then I did not trade until RTH. And even then in RTH, usually I take 3 to 6 trades a day. Last week, I was lucky if I took two trades every day. Or I'd take one good trade and then be done, right? I don't like losing money just for the sake of losing money, just to say I'm trading. I have other work I can do that gives me fulfillment and that will make me money that I'll go and do until the price action gets better, right? So if you're at all uncomfortable, if you don't understand what's going on, right, just sit back and watch and learn, right? You roll from one contract to a new one, Mohammed. I don't get into the mechanics of the rollover. All I do is I teach people how to do the rollover in my room and trade it. If you want to get into the mechanics of it and all the technical stuff, there's a huge amount of information on the Chicago CME website. It would explain it way better than I can. I'll teach you how to trade it. I'll teach you how to manage your risk. But I don't do the theory for rollover. The CME website will explain that a lot better than me. Make sense? You're just basically switching from one quarter contract to another. I think here I can cut and paste their stuff here. It won't cut and paste. Yeah, just go type in CME rollover explained into Google and you'll have, just type that in. Get everything you want to know. Settlement is the fulfillment of the legal delivery obligations associated with the original contract, blah, 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 blah. Now, trading it is the thing. Trading it is how do we trade it? How do we make money trading it? How do we manage our risk? And that's our focus, right? So for people who are just joining us, what I do at the Trading Syndicate is I try as hard as I can to teach people who don't know how markets work how to make a living doing this. right? And all retail people don't know how markets work, right? So what we're trying to do is we're trying to figure out where you should take trades and why you should take trades. And you should also understand when not to do business, right? Understanding when not to do business keeps you from taking bad trades, making bad business decisions, right? Realizing that you guys have limited amounts of capital, right? You can't really afford to be wrong a lot, right? And so what you want to do is you want to learn when to transact. Now, right now, the market is in distribution. We're taking, remember how I said earlier, we're taking that inventory that sold off Friday, and we're taking the inventory priced under 65.92, and we're selling that up at 65.97. Okay? For profit, right? So who are the people who are making money? Let's when you look at a market, who's making money right now, right? The people who are long under 65.92, 93, all the way down to Friday's low, they're the ones who bought cheap inventory, cheap product. They're the ones who are making money now. How do we benefit from that? Well, inventory's long, so we're looking for a correction to that overnight inventory. Now, in 10 minutes, London's going to open. London normally corrects inventory lower. So if you're looking for a short, like a hit and run short, right, a quick in and out short, when London opens up, if London can't get higher, if it can't get up over 65.98 or 6600, it will rotate down. So you'll take a short if you see a seller. If you don't see a seller, don't short it. Now, what do I mean by a seller? Now, it's really slow right now, and you're not making any money, so you have two options when it's like this. One option is to, well, actually, you have three options, right? One option is just to trade like an idiot. Just go long, go short, go long, go short, get stopped out, get angry, get upset, tilt, schmilt, all that crap, right? Pick up your monitor, throw it against the wall at 3 a.m. You know, you can just be you can be a fool, right? Or you can sit and watch and kind of learn something. Or you can just go back to sleep. So those are really your three options when it's like this. I like the second option because you actually learn something. So what I'll do and how I learned how to do this was I would sit and watch the offer, which is that red line. Watch a level and watch when the offer gets to that level. If the offer cannot move above that level and trade above it, that means that sellers are competing at that level and underneath. So effectively, you can see the sell orders. See that? Now, if this was kind of a more normal market, what traders would do is once they identify that there's price competition at a level, they'll short. Okay? So there are sellers competing at 98 and a half. Let's sell 98 and a half, 98 and a quarter. Where do we put our stop? 98 and three quarters. Because if they stop selling under 98 and three quarters, the market will go do this. Okay? You guys, you with me? Right? If I'm selling 5,000 contracts and I see you guys lining up to come in the store, I'm going to raise price to 99 half, 99 three quarters. So is shorting a good idea when price is going up? No. See, everybody, all these trading places, they teach people to short this. And that's why they get stopped out and that's why they get into so much trouble. What you want to do is you want to short the backfill, the backside of the move. That way you've identified that there are sellers present and lowering price. Now, if those sellers go away, right? If those sellers disappear, if they go away, why would you want to be short in a market where price is going higher? Like, look, just go and expand the candles, right? And try and learn something. Watch this level, okay? And then go and watch, draw a line. There's your sellers. They're right here. They initiated here at 98 and three quarters, and then they lowered it to 98 half. Then they came all the way down here. They found buyers at 97 and three quarters. So when they found buyers, what did they do, folks? They raised price. Now, if there's competition here, we'll go back down. See how it's going back down? But if these sellers see buyers, then they will raise price to 98 and three quarters. Does everybody understand that? This is the mechanics of trading that you can see on a 1 minute candle chart, especially when it's slow. You can see that offer move up and down and see price competition. It's moving so slow that you can actually learn something. Now, I know you're not making money and you're not buying a Lamborghini at this moment, but this is a skill of watching the offer, which is a universal skill that real traders look at, executing traders, not portfolio managers and things like that, but people who are executing traders. And let's face it, you guys, if you're a retail trader, you're an executing trader. You're not a fund manager. So you want to learn the mechanics of how price moves. Price moves when inventory comes into contact with order flow, which are customers. So the large sellers, market makers, wholesalers, right? They move price up and down dependent on how much buying is coming in. Do you guys understand that? So if you get a lot of buying coming in, they'll raise price. If they see buyers leaving the market, they will lower price to get them before they leave. Does that make sense? Pretend that you have a whole bunch of inventory, right? Inventory is stock, right? So say you're selling apples or you're selling oranges. You need to sell your oranges before the guy next to you takes your customer. Does that make sense? Hello, Bueller. Anyone? Okay? That is trading, right? When it's slow like this, you can sit and watch the offer move around. You can clearly see that there are sellers at 98 and a half and they're competing. The market is moving so slowly, right? It's so clear that you could see there's that 98 and a half. We've got a buyer at 98 and a half. Are they going, if there's enough buyers, that offer will now move up to 98 and three quarters, where that arrow is here. There, see? And print 98 and three quarters. Now, can we go 99, right? Can we get some fool to buy this at 99? right? Right? If they see buyers, right, their algorithms will raise price automatically. There you go. See? There's our fool. See? Beautiful, right? So if we were shorting, back to our thing, if we were shorting down in here and the offer started moving up, we would cover that short before we got stopped out. Make sense? It's moving slow enough that you can manage your risk before you lose a lot of money. That's what I'm trying to impart to you guys, right? You guys don't have any money to trade with, not compared to billionaires, right? You can't afford to be offside 20 grand in a trade. You may think that you can, but the reality of the fact is you can't, right? Because you're going to, even if you had $1 million and you're going offside $50,000 on trades, you're going to chew through that $1 million so fast it's going to make your head spin. Right? I have seen people do it. I've seen people lose large amounts of money. They start out with big accounts, they $600,000, $700,000 in cash, and they think they're rocking and rolling because they've got a lot of money in their account. So they start making big mistakes, and they're okay with that because I've still got, I lost 200,000, but I've got 500 grand left. You can lose that all in an afternoon if you make bad decisions, right? You can, especially those people who can't control their emotions, right? And they go on tilt and things like that. I have seen people lose 50, 100, $200,000 in half an hour, 45 minutes. Just gets worse. So don't be like that, right? Humility is the best risk management, right? Little humility is the best risk management. And the ability to admit you're wrong, right? Because if we admitted we were wrong on that short, if we were short at 68 and a half, 68 and a quarter, right? Admit you're wrong, get out. Take the take this 3 tick hit, right? 3 ticks is a lot better than 3 points. So now what's going on, folks? We got our seller here, right? 99 quarter. That's where they're competing. That's where the wholesalers are all sitting there competing. So let's see what happens in a couple of minutes now when London opens, right? I hope this is useful, folks, because this is the most practical thing you will ever find in trading that nobody ever uses because nobody ever talks about the offer. See how there was competition here? Now London's coming in. Let's see if London can take out that K high. That's a poor high now. There's price competition there, right? They're selling. Say you wanted to short. Say you had to short. And you shorted 99, 98 and 3/4. Just put your stop above 65, 99 and 3/4. You don't have to spend a lot. And then you'll be looking for the K low, right? If the market gets up over 6,600, you scratch the trade. So if you're short here, right? You're shorting here. Your stop is here. And then you're looking for this area here as your first area. Can we get under 97 and a quarter? Can we get under 7 3/4, 97 quarter, 97? And if you can't, right? If the market can't get down here, watch the offer. Watch the offer move down now, right? See, the offer is now above 99 quarter, but nobody would buy it. You got a double top, right? It's not the greatest trading, but it's great for learning. I promise you, if you sit and watch this, and you put the bid-ask indicator on a 1-minute candle chart. Watch, look, it's offered at 99.5, nobody's taking it. So the offer had to come back down to 99.25. Let me tell you something. I'll give you a secret, okay? If you're ever working on a deal and you're selling stock and you have to sell 50 million shares of stock in a company, if you're an insider or if you're selling for other insiders, you always want to be low offer, okay? You must be the offer. The offer is how you liquidate. The offer is how you get paid, right? Because that's how the brokerage industry works. You take stock and you convert it into cash, right? That's what real money is. That's how real money is made, right? You take stock and you convert it into cash. You get other people to buy your stock. That's why they call it a market, right? So watch the offer. The offer are the sellers. You know when they say prices are going up, buyers are in control? Think about how stupid that sounds. What buyer wants to pay more? Oh, it went from 50 to 75 a share. I'm in control. You really want to pay 75 or would you rather pay 50? You see how they say stupid things to confuse you guys? How can buyers be in control when price is going higher? Exactly, Patty Lou. You want to be low offer. You want to scoop like you are sitting around, right? There's you and Mother Truck and Dan and Muhammad and Phil and Raj, and you guys are all selling the same product. How are you going to make money if the other guys are undercutting your price? You can't say it's a better product. It's all the same crap. So you've got the only way that you can make money is price compete. Your offer has to be the first one that the buyers take. You nailed it on the head. Right? That is competitiveness in business. Right? You don't want to be sitting there holding 5,000 units of something and somebody has already sold everything to the customers and you're sitting there. Then the price goes down and now you're sitting there with inventory that's not priced well. What's the point? Your job as a trader is to turn inventory into cash. See? So if you're shorting against that overnight high, which is a double top, you're short 99, 98 and 3/4. Your stop is 99.5, right? And you're looking for bids at 98, 98, 97 and 3/4. So if you're short, put a little buy order in here and see if you get hit. Because if you can't get filled on one measly micro contract here, it's going to rotate higher. Or it's just going to go back and forth here, which is one of the most frustrating trades to take. But if you're watching, right, now you're cooking with gas. You know the sellers are here, right? Now you're learning something. If you learn this, if you can keep this simple, you will simplify your trading drastically. You won't take stupid trades. You won't make emotional decisions nearly as much as you usually do because you actually understand the business that you're trying to make money in, right? The reason retail traders don't make money is because they don't understand what the hell's going on. And they've got a head full of useless information that doesn't allow them to actually turn information into cash. You know what I mean? They're talking about iceberg orders and, you know, frickin' Cool Ranch gaps and, you know, flaming hot Cheeto gaps and all sorts of nonsense when you should be thinking about where do I put my bid? Where do I put my buy order? Where does the trade stop making sense? Why am I taking this trade? What is the business reason for the trade? Okay, now I'm in the trade. What do I have to look out for to make sure that this trade works. So if you're short, right, you've got buy orders in the market here at 98. Say you shorted 3 contracts here. Put a buy order in here. Put a buy order here and put a buy order here because it's a thin market. So if you can't come down here and get filled on these bids, right? Guess what? You're just adding to the support. When you go in and you put in a buy order, you're creating support. It's an unfilled bid. Right? Make sense? Trade tactically. Don't don't fantasy world trade. Take about 99% of what you think you know about markets and get rid of it. Get practical, right? Get practical, get paid, right? Simple. How many people sit in front of the screen, try all sorts of different stuff, and don't make money? Sound familiar? I mean, you're just spinning your wheels and spinning your wheels. You're trying indicators, you're trying this, you're trying that, right? You're being told to look for iceberg orders and Hindenburg offers and all sorts of BS, right? Total bullshit. Excuse my language, right? You're not making any money. You're getting more and more frustrated. Sound familiar? Because that's what retail trading is, right? They're just baffling you guys with a bunch of BS, spinning you all around, and you never actually make any money. If you're tired of that, right, get practical, get paid. Get practical, get paid. Practical information, right? Don't look at things like correlation, right? What are you trying to, you can't even watch one market. Why are you trying to correlate two, right? Do you see just simple common sense, right? Just simple common sense. That's all you need. Hey, Omen, what's going on? Right? See how it's going down at 98 and then popping up at 98 and a quarter, and down at 98 and popping up, and down and popping up, down and popping up. So what do you understand from all of this? Number one is, the first thing is, I'm not trading this, right? You got to be a bit of a price action snob. Okay, do you see any follow through? Do you see a business opportunity here? Right? The chart is telling you that business for you as a retail trader now is horrible, right? The chart is telling you that the wholesale traders are making all the money because they own all the inventory from the sell-off on Friday and from early morning, like last night's early session in Globex, and they're selling that up here for profit. But because the volume is split between 2 contracts, you're not getting a lot of follow through, right? So it's just back and forth. And they, you know, if I had 5,000 contracts at, I don't know, 65, 88, right? I'd be happily selling them here at 98. 2 at a time, 10 at a time, 20 at a time, nice and slow. Just don't scare away the buyers. See what I mean? And that's what creates chop, right? So do you understand what chop is? Chop is created by slow business conditions. If you understand that, are you going to transact? Any questions? So now you would have covered one contract. Now you're waiting for the next one. Did you get a fill at 97 and a half? Right? Say you're short 99, 98 and three quarters. Did you get a fill at 97 and a half? Because it traded down there, but did you get a fill? Right? So your buy orders when you're short, your buy orders are telling you whether your short is working. Make sense? Because if you're short something at $5 and you put in a buy order at 450 and that 450 buy order does not get executed, that means somebody's buying ahead of you and you're going to have to price compete. See, normally when you see a poor high like that, right, you can automatically go and short that, right? Poor high means sellers are competing, short it, put your stop above, and then usually in a faster market, you can look for a 94, 95 cover. So if you were short 98 half, looking for a 95 cover, you can make a nice 3.5 points on 3 to 5 contracts. It's just because it's rollover, it's less follow through, right? That's how you trade a poor high, right? Just like a poor low. Poor low, you're long, you stop, and you sell into strength, right? Very simple, right? So poor low means that buyers are competing, right? So you buy here, you put your stop here, and then you sell as the market goes higher. Okay? Those are the two most important things about market profile when you talk about highs and lows. Poor low, poor high. Here's a news flash. The people buying here are the people who are selling here. These are the same people. And they're just creating that back and forth for you guys to play around in, right? They set they set the edges of the sandbox. So you guys can play in the sandbox. Make sense? Hey Jerry, how you doing? Do I have any stats on whether to expect the sell back down to Friday's liquidation cost basis? I do not. I don't use stats in my trading because I get biased. So if you tell me there's a 70% probability that we're going to sell back, I'll start getting short biased. And I'll start ignoring the actual order flow. That's just me. Because I have a problem, like I know myself, I have a problem with bias. So if you start saying it happens 60% of the time or 70% of the time, whatever, then I'll start trading to the short side, right? It just happens naturally. I'll start making mistakes. So I'd prefer not to know, right? I'm a pure price action trader and inventory trader, right? There are people who keep stats, Jacques. I'm sure there are. I don't. Does anybody in the room have stats on that? On whether to expect the sell back down to Friday's liquidation cost basis? Be interesting to look at them. But I'm not a stats guy. Yeah, that can happen. Exactly. I know exactly what you're talking about. I just don't have any numbers on it. Because usually once the POC moves up, generally, and I'm putting generally in quotes, right? Generally, once the point of control moves up, it means successful distribution, right? You've got that, right? So after a successful distribution, what do? They put it on sale a little bit because they run out of buyers, right? The thing is, sometimes they have to put it on sale because the POC doesn't move up, right? Like right now, they've had to put it on sale from 98 down to 96. POC hasn't moved up yet, right? We have quants, and we have lots of, you know, stats people in the room. So we found some bids at 96 and three quarters. How can you tell? Because the offer started to lift, right? The offer started to lift, right? We were offered here, and now you see the offer starting to lift. We're going to go look and see whether we can get up here now. See, the offer is right here where the sellers were before. Let's see, can we get a print? Can we get a print? Look at this. 653 contracts. Maybe we'll move that point of control up here. We need like another 100 contracts or so at this price. Oh, look, we got the print at 98 half. Look at that. So now your short is over. You guys see that? If you were shorting 98, 98 half, 98 three quarters against the overnight double top, you'd be looking, you should have covered by now, right? Yes? No? Yeah, Edgefield doesn't have any stuff on market profile as yet. Oh, lifting up to 98. Look at that. Look at the look at the offer move, right? Right back to that overnight high. You see how the short, we called out the short, we took you through the short, and then the short was over, right? You see that? Is that, did you guys learn anything tonight? Hopefully. You learned how to short and you learned how to get out of the short before you lose all your money, right? Practical. Get practical, get paid. Get practical, get paid, right? Get rid of all of this, all of that useless crap you've got floating around in your head. And I'm saying this with as much love and respect as possible. Clean your head out of all the crap that goes around on Twitter about people talking about just useless crap. Learn why a trade works and why it fails. So when you're actually putting on a business transaction, you will understand the reason why you're taking the trade. When the reason for the trade stops, goes away, you and your money are gone. Thank you very much. Have a nice day. Right? What was the business reason for the short? Let's recap now, okay? Business reason for the short was number one, we saw a seller. We entered the trade, we put our stop here. We put buy orders down here so the market would hit us on the way down. Right? If we had a buy order here and it didn't get filled, we should have been out of this trade at 96 and 3/4. Are the levels working? Yes. Cover. Boom. The business reason for being short no longer exists. Right? When in doubt, get the F out. Right? Don't sit around hoping and waiting and praying that the trade comes back. The business that you were hoping to have happen has finished, has concluded. And you have to take advantage of it in the time provided. If you didn't, take your loss. Because if this thing gets above and starts going, you're looking for 6603 and 3/4. Good grief, that's a handful. And then Friday's high. Right? Once we get above Friday's high, folks, it's clear sailing. There's nothing up here. Right? There is no inventory up here to sell into. We are at all-time highs. Okay? That's how you trade an inventory correction, and that's how you manage your risk during these corrections. Right? That's hit and run shorting. So I want you folks to be profitable. And if you can't be profitable right away, don't worry. That's how this business works, right? At least don't lose a lot of money while you're learning. And that's what we teach you at the Trading Syndicate. We teach you how not to blow up your account and lose all your money and then get all mentally screwed up because you've done so. We keep you level and even on a straight path with practical information that you can actually put into use every day and make money, right? And save money and be smart. We take you from dumb money to smart money through practical, simple, proven business methods, right? Very simple, right? The sellers have now found buyers. They're raising price to take advantage of it. That's all there is. Yeah, Omen, you're joining us a little late, brother. Not a problem. It is a distribution, right? Like I said at the beginning when I started, we're distributing what we bought Friday at the close. We're getting rid of that at night. No problem, right? We're getting rid of it at night to new buyers, right? Right? So exactly, we are in distribution, right? Cool. Good, good, good. What what software is that, Omen? That's Tradovate. Ah, not bad. Cool. People are always asking me about software. Yeah, mine hasn't yet. I need another 10 contracts at 98 quarter. But I see what you're talking about, right? All data feeds have different contract numbers. It's really annoying because all these different data feeds, I guess it's called collating data, or they gather data from the CME in different ways and slap it together. Whereas in equities, there's just one data feed. So I need 3 more contracts at 98 quarter. Come on. 4 more, actually, because it's 7:33. There, box moved up. See, mine moved up slow. There it is. See, it went from here to here. So the POC was here, and it's moved up here. Now, we'll see. Do we get... Does that bring in more buying, or do we have to put it on sale again to coax buyers into the market? Right? We'll see. We'll see. Let's see how the... So we're almost there. Old contract has 36,000 traded. New contract 29,000 and a half. Okay. And that's it for me tonight, folks, or this morning. We will see you at 9 a.m. Yeah, there's definitely a lot of interesting stuff happening this week, Raj. We'll see what happens. Just stay open-minded and make sure you have your hand on your wallet at all times. Thank you, everyone. Have a great morning. We'll see you at 9 o'clock. Come visit us at thetradingsyndicate.org if you want to get practical and you want to get paid. Thanks, everyone. Appreciate you being with us. We'll see you in a bit. Bye for now.